10 ways rich people avoid paying taxes. Hello again and welcome to what could be the most pivotal instructional video you've ever seen. This will teach you how to keep more of your hard-earned cash than ever before. The income tax, as Albert Einstein once put it, is the hardest thing in the world to understand. The wealthy can afford to hire very costly accountants to help them pay as little tax as possible. In this video, you will find 10 examples of how the wealthy avoid paying much in taxes. Number 1. Invest all of it. The wealthy don't hoard money unless they have an immediate and pressing need for it. The number one law of taxes is this: any profit that is reinvested does not have to be paid tax on. You can avoid paying taxes on $5 million in profit if you reinvest it in your firm before the end of the fiscal year and use the funds to expand your operations. This is the key to a company's rapid expansion. The owner's personal wealth can skyrocket with little or no impact on their tax situation. Number 2. Everything you use is owned by a business. The second tax optimization tenet is to claim every deduction possible. What I mean is this: a company's operating expenses are not considered personal income. You want to get yourself a new car? True, but the business could use the vehicle too. You needed to run the business, therefore let the company buy it on the company's money and you can continue to use it. What follows are some of the deductions that the wealthy make when investing in hardware, software, etc. There is no business without computers, cell phones and other technological devices. Business trips necessitate travel, hotels and flights. Costs associated with maintaining a home or business, including rent or mortgage, furnishings and basic services like electricity and internet. To eat out is just another business expense you can write off. The fewer funds left over after deductions have been made, the lower your tax bill would be. Number 3. Move somewhere with little to no tax. The magnitude of the effect is frequently underappreciated. What effect would relocating to a country that did not need to declare your earnings have on your lifestyle? This was the norm in days gone by. If you had your choice, you'd uproot and head to Dubai, main residence in Monaco, the Simon Islands or the Bahamas. Earnings in these nations are not subject to taxation. Paying taxes on your earnings is optional. This is, however, a catch. As a result of the high cost of living there, only the wealthy can afford to live there. Living expenses in Monaco are among the world's highest, number 4. Even so, as a result of high cost of living there, only the wealthy can afford to live there. Number 4. Even so, export it nonetheless. In this manner, the tech giants like Apple, Google and Facebook operate. They organized businesses in the Emerald Isle. Due to the favorable tax climate, these corporations have acquired ownership of the IP. In order to continue producing the selling products in the United States, the US company must annually pay a licensing fee to the island company. Thus, the US company incurred a legitimate tax-deductible expense. By employing this scheme, they are effectively removing funds from the US economy and remitting them to Ireland, where they will pay a tax rate of 1% at best and potentially even less with further optimization. One option is to establish a foreign subsidiary in a low-income tax jurisdiction and send invoices to the United States. Reimbursement through a US-based subsidiary can reduce taxable income in the parent company's home country. These internet companies would rather pay a fine than their fair share of taxes. Ultimately, a fine is a tax on wrongdoing, which becomes clearer upon reflection. Put another way, a tax is a penalty for doing the right thing. Interesting, isn't it? Number 5. Charitable donations. The fifth tax rule states that charitable contributions are not subject to taxation. For this reason, every highly wealthy person also owns a foundation. However, in their defense, state governments have historically been terrible at budgeting. As a result, rather than handing over your wealth to the government, which might spend it on anything it wants, a charitable foundation is a superior option of ensuring that your contributions have a meaningful influence on the world around you. Interesting questions arise when considering the fact that even tax-exempt organizations like foundations incur costs that can be written off. In order to function, they require certain items. Donating something you own to charity is still considered a donation. This includes real estate, cars, and other assets. The leader of a charitable organization can keep driving the officially given vehicle. Number 6. Instead of a salary, take the equity. Pay me in equity, as the Queen Bee expressed it. There are two motivations for doing so. For one, the value of a share investment could rise. Second, unless it is sold, equity is not subject to taxation. Interesting. It's because of that Elon Musk became wealthy so rapidly. It's true that Elon makes somewhere in the range of $0 to $23,000 a year. Sure enough, that's how much Elon Musk takes home every year as Tesla's CEO. Elon receives newly issued stock based on the company's performance. His wealth is increasing rapidly now that Tesla is a publicly traded corporation. And if things keep going this way, he'll soon be the wealthiest person on the planet for sure. Number 7. Buying art. One fact that wealthy are privy to is that the art market is the only significant one that is not subject to government oversight. As with any other purchase, the cost of purchasing art must be taken into account. If you have been following along, you also know that many costs have a potential tax write-off. But the wealthy understand this and has several facets. Consider the possibility that you may spend all of your $1 million salaries on a single artwork this year. Since there is no remaining taxable income after deducting all expenses, the situation is ideal. You have had your picture for 3 years and in that time it's increased its value to $6 million. You decide against making a profit by selling the piece and instead to donate it to a museum or even better, your own art foundation. You can now deduct $6 million from your taxes. Number 8. Multiple nationalities with no fixed residence. This is the most dubious and perplexing option on the list. But people have successfully used it to avoid paying taxes in every country. You are obligated to pay taxes to the government of the nation in which you currently reside. But what do you do if you lose your nation of origin? There are many extremely wealthy people who have no place of origin while owning property all around the world. When asked for identification, the Thai or Bhutanese property owners submit documents written in language neither governments understand and with no intention of translation. There are also those who choose to make their enormous yachts their permanent residence. You could be anchored in the Mediterranean Sea off the shore of Monaco one day and in international seas the next. Although holding dual citizenship has certain advantages, we do not believe that completely eschewing modern conveniences is a viable long-term strategy. Number 9. Gift money away. Did you know that gifts to persons are not subject to taxation? Insane, right? You may be thinking, cool, but this is a film about incredibly affluent people and how they optimize to get the most of it. Because there's a $15,000 cap on the present. However, if the donation is worth less than $15,000, you don't have to tell the IRS about it, as it counts as a non-taxable event. Gift-wise, you are kind of true because a $15,000 doesn't get you into the Rolex game. Though a $15,000 doesn't seem like much at first glance, it actually provides greater wiggle room. In the United States, The lifetime gift exemption will be capped at $11 million in 2021 in the event that the total amount of all gifts is under $15,000. Number 10. Hold it in the privacy coins. In terms of both ease of transfer and safety of wealth, crypto is a game changer. That $1 billion can be mounted on a stick, slipped into a pocket, and used as a ticket to Singapore is mind-boggling. Bitcoin and Ethereum are two of the most extensively regulated cryptocurrencies. Therefore, there are safeguards in place to ensure fairness, give transparency, and connect users' wallet to their identities.